Welcome to a quick video on accounting changes. Accounting changes will arise periodically. They may be mandated changes, they may be voluntary changes. Either way, they'll hamper comparability between the information between the years shown. Accounting changes and accounting errors are discussed comprehensively later in the textbook. We introduce them here. There's three general categories of accounting changes. Changes in accounting principle, a change in an estimate, or a change in reporting entity. We'll talk about the treatment of each in turn. Here's the change in accounting principle. A change in accounting principle refers to a change from one acceptable method to another. Maybe a mandated or a voluntary change. And there's three possible approaches that might be taken to implementing the change. They are the retrospective, the modified retrospective, and the prospective approach. Think about what those words mean. Retrospective means backward looking. Prospective means forward, from now on. And that's what the approach is going to reflect. In the full retrospective approach, we restate all years shown so that the reporting is as if the new rule had been used throughout. In the modified retrospective approach, the new standard is applied to the adoption period only. Prior periods are not restated, but a cumulative effect of the change on prior periods' net income is shown, and it's shown as an adjustment to the beginning balance of retained earnings in the adoption period. So the accountants will still have to determine that cumulative change on those prior years. The third possible treatment is the prospective treatment. The prospective approach means that the change is implemented in the current period and all future periods without regard for what would have been the impact on prior periods. Let's talk more about the change in accounting principle. The treatment of the change in accounting principle is going to depend upon whether it's mandated or voluntary. If it's a mandated change, mandated by a regulatory authority, such as the Financial Accounting Standards Board, the regulatory authority, such as the FASB, will prescribe whether the new rule will be implemented via the retrospective, the modified retrospective, or the prospective approach. The regulator's decision will be based on the magnitude of the difference in the information, how big the change is, and how much difference it makes in the financial statement information versus the cost of making the accounting change. So essentially, the regulator will do a cost-benefit analysis and look at the relative benefit of the accounting change, which is clearly a little significant since they're making the change, they're mandating the change. But if it's a marginal difference, just made the threshold for being worthwhile changing, but the cost of carrying it out for the company would be huge, they might use a more simplified approach, a less expensive approach to implement, I should say, such as the prospective approach. Now, if it's a voluntary change, all bets are off. Voluntary changes in accounting principle are implemented retrospectively. Let's look at changes in accounting estimate. Estimates are a frequent and necessary aspect of accounting. We make a lot of estimates. Common estimates include, but are certainly not limited to, the amount of future accounts receivable that will prove uncollectible, the amount of sales that will be returned, the amount of warranty losses that will be incurred, and many, many, many others. Changes in accounting estimate are accounted for prospectively. That is, we incorporate the new estimate from this point on. Now, if that effect is material, We certainly will want to provide a disclosure note to describe the change and provide the effect on net income and earnings per share that the change had. There's one special case to keep in mind here. Changes in depreciation, amortization, or depletion method, they are actually considered a change in accounting estimate that is achieved by a change in accounting principle. Recall that in general, voluntary changes in accounting principle are accounted for retrospectively. The change in the depreciation, amortization, depletion method is a special case. They will be accounted for prospectively. However, a clear justification for the change must be provided. That is, the company must describe why the new method is preferable. And that's change in accounting estimate. The third change is change in reporting entity. There, it's a completely new entity, so the changes will be very vast. Right. Thank you for your attention and have a great day.